Hi guys, welcome back to the channel. My name is Dave, and today we're going to be talking with Troy Cates, the co-founder of NEOS Investments. We're going to cover their entire ETF lineup. We're going to focus on QQQI. This is their latest ETF release. It's a NASDAQ covered call ETF that distributes that lovely monthly income that everybody loves so much. It's kind of a sister fund to SPYI, which is kind of their flagship fund. This one's been around a little while, and people have grown to really like this one. It's grown to over $1 billion of assets under management. It's headed quickly towards 2, maybe 3, which might allow Troy to get that Hamptons house. We've talked about that. That's our goal. We want a summer party pad. That's the goal. And we're going to cover everything from the option strategy to tax treatment and return of capital, or ROC. We'll talk about the typical investor for these products and also talk about the new products that they have in development over at NEOS. We'll also get Troy's take on the new option-based ETFs that are yielding incredible numbers like 60, 70%, and get his thought on some of his competitors. So if you are considering any of these products, this is the video for you. So like and subscribe, buckle up, and if this is what you're looking for, please stick around. Whoop. I guess first of all, congrats on SPYI. This kicked off back in August of 2022, right? So we're coming up on about 2 years.
Yep.
Your AUM is really growing quickly now, right? Rapidly, up to like 1.3 billion when I just checked. Total return last year was around 16%, and you distribute about 1% every single month. So this is the one that started it for you, really, right? This is your big one. You target that 1% income or distribution every single month. So I guess we've covered SPYI, but why do you think this segment with these ETFs, everything's growing so quickly? Why do you think there's so many products that are coming out right now that kind of service this covered call segment?
Well, first of all, thanks for having me on again to talk about these products. But yes, the space has grown tremendously over the past couple of years, specifically even the past year and a half. I think about yes, we launched SPYI and 2 of our other ETFs, BNDI and CSHI, in August of 22, and just seeing the growth, not only of our products, but just the growth of the space in general. And I think really when you look towards this active, call it covered call option-based ETF space, we're seeing a lot of growth there. Something we always tell our clients and anyone looking in the space is do your homework. There's so many new products coming out. Some of them have very large, flashy yields. In the end, I think you got to dig in. The nice part about the ETF structure is it's transparent. You can go on at any point in time, pull up our holdings on our website, dive into what equities we own in SPYI, what short calls we're short in the option portfolio, and really understand what the portfolio is doing. And like you said, our performance last year, we're actually up just over 18% total return, and we did distribute about 12% of that, so a 6% price appreciation on the underlying NAV outside of that. So it was a really nice product for last year, given we were up 18, almost 18 and a half, and the S&P 500 was up over 26% for the year. So capturing a lot of that upside is what we wanted to achieve in SPYI, and that's how the product works. And I know we've gone through it before, but I think it's starting to gather more assets, and I think a lot of people are looking at it because not only do they look at what the performance was, maybe how steady the distribution was over that time frame, but they kind of look at starting to look, even though we're a younger firm, NEOS is only two years old. They look at us as more of experts in the space in the sense of we've been doing this for a long time. I know you and I have talked about it before. We launched a lot of those early option-based ETFs many years ago. And so we've been in and around the space for a long time. And I think when people understand what we're trying to do with the NEOS products, they get that we're option managers. There's a lot of products out there run by other managers that are kind of like a bolt-on business to maybe their thematic or long equity or whatever part of their business. But for us, NEOS stands for Next Evolution Option Strategies. It's all we focus on. It's what we really pour everything into is option-based strategies. So it's something that we really hold dearly, and we look to continue to grow in that space as we have more funds in registration. We have a few funds that we're acquiring or adopting over to NEOS. So we have more coming out, and we'll definitely keep people informed as we have more of those out.
So it's more the market is kind of moving you that direction too, really, because SPYI, the growth there, I mean, right, that kind of dictates what you're going to be rolling out next. And that probably was what really was the impetus for QQQI.
Yeah, I think when we launched our first three ETFs, so it was SPYI for the equity, core equity exposure, CSHI for that ultra short duration kind of cash T-bill exposure, and then BNDI for that fixed income exposure. We wanted to figure out how we start to slice that, pie a little further down. So we wanted to get QQQI, which is our NASDAQ 100 high income ETF, out to the marketplace and really have another offering in that core equity exposure. SPYI has obviously a lot of the same stocks, but when you look at what the underlying holdings are of QQQI, those long equities, those 100 or so equities, that's the same basket as the NASDAQ 100. We're just trying to track the NASDAQ 100 from an equity standpoint of what we're holding there. And then our options, we're using NASDAQ 100 index options. We're using those NDX index options to bring in that additional income and bring in where we have now just over a 14% yield. And if you think about it, when you're looking at the S&P 500, you're looking at the VIX for volatility. When you're looking at the NASDAQ 100, you're looking at the VXN. And the NASDAQ 100, given the makeup of the actual index, you're going to have some more volatility in there. And on average, that's about 20 to 25% more volatility than the S&P 500. Hence, when you're bringing in premium from selling those calls, you're bringing in more premium, and you could, distribute more. That's why the yield's a little higher in QQQI versus SPYI. But both of these products are built to move higher and appreciate with the market. Of course, they are in the end covered call products, so there is a point where they are, essentially capped out and they cannot continue to participate within that time period, that monthly roll. But I think if you're looking at something that you want to appreciate higher with the market, but also get a tax efficient distribution, then these are definitely two products to look at.
So QQQI is SPYI based on the NASDAQ. Same exact strategy overall, just the NASDAQ version. Higher levels of volatility, same expense ratio, 0.68%, right? Both.
Correct. Yep.
So with QQQI, a little bit more volatility, you can sell a little bit further out of the money. I guess, can we talk through the option strategy that you overlay with this?
Sure. Yes. So very similar to SPYI. But again, when you're thinking about how our rules-based systematic strategy works, SPYI is looking at different levels of volatility or the rate of change of volatility of the S&P 500, so that VIX index, whereas QQQI is looking at the rate of change and the different levels of volatility for the NASDAQ 100, which is the VXN. So while the strategies are very similar, when it's looking at it, yes, it can write calls further out of the money while still bringing in enough income to distribute. But also part of our strategy and the way our rules-based systematic model works is the percent overlaid on the entire notional of the portfolio can vary month to month when we're rolling. Usually it's in the 70 to 80% range. Right now, to give you a live update, it's just about 70% covered or so. So that leaves a good, call it 30% of the portfolio that's not capped by any short calls, no matter how far out of the money they are. I believe when we rolled the calls this month, they were anywhere from 1 to 4.5% out of the money, but we still had a good portion of the portfolio that was not capped by those short calls. So that can continue to move higher as the NASDAQ 100 equities move higher.
Okay. And you sell those out about 6 or 7 weeks, and then you roll about halfway through that process out further into the future, right? Okay.
Exactly. So we roll at the end of every month, and the duration's a little further, about 6 or 7 weeks, like you're saying. So when we're closing those calls at the end of this month, there still would be another, call it 2 weeks or so before they would have expired.
Then do you guys target a particular delta, or is it more a monthly targeted distribution rate that you're looking to achieve?
So there's a number of things that go into what the model's looking at, but yes, it's targeting specific deltas, but also looking at the premium received off of those deltas, so what can actually be distributed. And the way we build our products, whether it's SPYI, QQQI, or any of our products, is we're trying to build a product that could have not only a specific or a range of distribution yield throughout the year. Like QQQI, we're seeking to be able to distribute 12 to 15%. We're not only doing that, but we're trying to build a product that could sustain that kind of distribution. We're not looking to bump the distribution up or take more risk on, or have something that's really going to erode at your principal of the fund's NAV. We're looking to build a product that can sustain this distribution, and that 12 to 15% for QQQI is the range that we've have set for it.
Okay, so you plan on holding that pretty steady month to month? So people can count on.
That's the goal. I mean, right now, even with these lower volatility levels, we're still bringing in enough. The fund just went X today, and the forward distribution is just over 14%. So we're still able to bring in enough income to have this, in this 12 to 15% range, but we're sitting right around 14% right now.
Lots of volatility. You kind of mentioned this. Lots of volatility has been squeezed out of the market already, right? We're sitting at a VIX of around 12.
Yep.
So in a VIX environment like this, how does that affect the fund and in your option positions? Are you selling a little bit closer to the money? Because it feels hard for I like to sell a lot of puts and calls and things like that on positions that I have, but it's getting tighter and tighter, especially on some of the big indexes. So.
Yeah, so that's exactly what it is. So if you think about it, as these volatility levels come in, like you said, the VIX is sitting around 12. As it comes in, it's only a couple of weeks ago, it was around 19 or 20. So as it comes in here, you're bringing in less and less premium when you're selling these calls. So yes, do you have to write for our products them closer to the money, or do you have to write on more of the notional? So it varies month to month, but that's something that our model is definitely looking at. And I know we've talked about this before, and people always ask us, they say, hey, we read your prospectus and we see that you can change from just being short calls to going into a call spread where you would sell a call, bring in premium, use some of that premium to buy a call further out of the money, but still have a net credit so you could distribute that premium. And we say that, yes, that is one of the mechanisms in our products, at least for SPYI and QQQI, where you might have these levels in volatility that get so depressed that we're not bringing in what the targeted income was. So we can switch to that call spread. And that could change month to month, but that's what our model is looking at when it's deciding what short calls to be in, or are we at a level where we have to go into the call spread where we'd have to write closer to the money, but we don't want to miss out on the upside and cap ourselves so low if we do have a big move higher during that period. So it's something that is in the model for SPYI since inception of August 22. We have not gotten to those levels where we would need to do that, where it would switch on that, month or 2 months, whatever it might do. And QQQI, we have not done it yet. So both products have not been in the call spread since they've been live, but the mechanism is there for it to switch over if needed.
So then I know it's data driven, but who manages your options selections? Is there a service involved? It's all you guys. It's in-house, right?
It's all us in-house. So we don't sub-advise out any of our funds. We do manage other people's funds as a sub-advisor, but for our NEOS ETFs, they're all managed here. So there's, Garrett and I are two main portfolio managers on these products. So when we're rolling these options on a monthly basis and going through the rules base and the systematic process of what strikes are going to be picked for the next month, then we work with our trading desk. We have two experienced traders with over 20 years experience. So between the four of us and the whole product management team, we review everything before we're rolling these options into the next period. And then, throughout the month, as you have inflows coming in, you're adding to those positions as you have those inflows come in.
I mean, and that says a lot that you're managing your own option positions and other people are coming to you to work with you on their particular products. And then I know your background is in options as a market maker as well, right?
Yeah. So when I started my career, I sat on a trading desk and we made markets in equities. We traded a lot of options, and then I spent a good portion, well over a decade of the first part of my career, trading equities and options in various different trading desks before my current co-founding partner and I decided to move on and start our own asset management firm that we were bringing out a lot of those early option-based ETFs. And that was well over a decade ago. But like you said, I've been in the business over 25 years. So I've spent a lot of time sitting on trading desks, managing order flow for large pensions, endowments on the institutional side. And, when Garrett and I wanted to start up NEOS a couple of years ago, we just realized that we wanted to take a lot of this expertise we had, a lot of the knowledge we had of managing these funds in private vehicles and other things outside of ETFs and bring it to the mass market. How can we bring these great products, put them in an ETF wrapper, which we love because of the transparency, the tax efficiency, and everything that goes with it. And anybody can go online to their online trading account and buy 1 shares, 100 shares, or whatever they want and have access to these kind of portfolios.
So is there an advantage for a company like NEOS when it comes to options, from your background as being a market maker, when we're talking about bid-ask spreads, for example, are there advantages for a large company like yourself managing positions like this?
I think it helps when people want to come to us and ask us to either sub-advise their funds or help work with them on different products, or just in general. I think for us, since we have a deep trading background and understanding of what's going on the other side of the market, it helps when we have conversations with our market makers on how these products are not only going to trade from our standpoint, but how they might trade in the marketplace, and how a market maker might look at his or her risk on the other side. Because when you think about it, when you're making a market in these names, when you're at one of these big market making shops, you're taking risk on either side of the equation. And if you have a lot of, say, buyers coming into your fund, until those market makers do what is in the ETF industry creation unit and create that short stock into for them to get long stock, they're short these positions. They're short, say, QQQI. As they get more and more short, they'll do a creation unit where they'll get delivered new shares of the stock and kind of flatten out the position. But in the meantime, they need to hedge that on the other side. Sometimes there's overnight risk for them. They want to make sure that as they're making a market, they're not going to really lose money on that. So they hedge it out. And, as the products grow and there's more and more volume, more market makers get involved in the products, the spreads get a little tighter. But all of our products that we've built, we wanted to make sure there was deep liquidity for. The liquidity is not always what you see on the screen. If you think about liquidity for any ETF, whether it's ours or any other, the liquidity is in the underlying holdings of the ETF. So when you think about something like QQQI or SPYI, what's the underlying holdings? You're long a basket of NASDAQ 100 stocks in QQQI. So those stocks are some of the most liquid stocks in the world. And on top of it, they're tied to some of the most liquid indexes, the most liquid index in the world. So you can kind of get an idea of how liquid these products are when you actually need to buy or sell them.
Yeah, when I think about a market maker's job, I think people think of it as a cash grab, but it seems like it'd be extremely stressful, and you can lose a lot of money real quickly, right? I mean,
you can lose money very quickly, and it is a stressful job because they're constantly, if you have a lot of buyers coming in and they're consistently, selling to those buyers and trying to hedge out those positions, there's a lot that goes into it. It's not just, I'll sell them here and I'll buy them back here, and they do that all day to make money. There's definitely more that goes into it.
But now let's talk about something you're not allowed to talk about, which is taxes. We'll just touch base on it a little bit because I think it is important, and it is in your prospectus when we're talking about 1256 contracts and things like that. So that gives you 60% long-term capital gains, 40% short-term capital gains. And that's a nice perk when you're doing index options that are often overlooked. And one of the reasons that a lot of people should just be looking at index options if they're going to get into selling options against the indexes versus SPY, for example. So you distribute about 12% a year. And I looked at my statement because I have a few shares of SPYI, and return of capital is around 66%. Let's call it 2/3.
Mm-hmm.
Right. So if you're looking at 12%, and I see this as a big advantage, and sometimes it's overlooked. If I receive 12%, I have to pay, capital gains on that, especially with short-term capital gains. I'm going to get hammered. I'm about 40% tax bracket for myself. So you can do the math. But if I can reduce that by 66%, and only instead of paying on 12%, I'm paying on 4%, I'm feeling pretty good about my position at that point. I'm only paying, on 4% this year. So it's a great stream of income at the moment, and, especially for an older person, maybe that's working towards retirement, kind of what their tax bracket is, or they're headed towards retirement. And then the ROC, in my mind, I'm reducing my basis, right? So if I put in a big chunk, let's say I put in 100 grand and I'm receiving the return over time, I'm reducing my basis. But after a year, anything that I do end up selling as far as the shares go ends up being long-term capital gains as well. So I see that as a smart way to play a product like this. I mean, is that kind of the right way to think about it? And then I guess one more thought before I jump over to you is, like last year, we were up significantly in the S&P, like 25% or something like that. So during a period like this, we have these big gains, and you're holding the stock, but you're selling the options. So we're long stock, that's fine. We're not selling any of that. but we're selling the options and we're going to incur some losses along the way. When we incur those losses, that's probably where we're generating a lot of this return of capital. Does that all sound correct?
So yes, you had it exactly right. But just to rewind a little bit, think about those index options. That's a really important part of what we're putting inside the ETF. Index options, like you said, get that Section 1256 contract rule, which you get 60% long-term cap gains, 40% short-term cap gains, no matter the holding period. So that's a really important thing when you're thinking about a product like ours or looking at some of the competitors' products that might distribute, might use ETF options, single name options, equity linked notes. Those are all distributing ordinary income. So yes, you get that higher tax bracket with those. So when you're thinking about using index options, these are some of the most liquid options in the options market. We're getting not only the liquidity, but we're getting the tax advantage from using them as well. And then when you go over to thinking about, just like you walked through, thinking about the portfolio, you have this basket of long stocks that, yes, there's points during the year where we're rebalancing to make sure we're tracking the NASDAQ 100, for example, in QQQI, or adding, deleting any names that they might pull out of the index or add to the index. But for the most part, you're trying not to touch that underlying basket of equities. But we have this monthly trade with the index options. And as those index options have a P&L every month, some months will be profit, some months will loss, those will pair off. But over time, if a market's moving higher, like you said, you used the example from last year, you're going to have these embedded losses from the option portfolio. While we're still bringing enough premium to distribute, you might have some P&L losses. And then, yes, part of that distribution could be classified as return of capital. So yes, close to 2/3 of the distribution last year, if you looked at your 1099 from SPYI, was considered a return of capital. Now remember, the ETF was up over 18%. So you had a 12% distribution, which about 2/3 or so was classified as a return of capital. So that did lower your cost basis, but you did pay less in taxes last year, and you deferred those taxes going forward. And just like you said, if you decide after a year to sell the ETF or so forth, you're probably in a better position getting more of a long-term capital gain versus a short-term or ordinary income kind of tax situation that you might be in.
Yeah, and by the way, we are not tax professionals. If you're out there,
we are. I am not a tax professional.
I rely on a tax pro myself, but I think it's very valuable information. And when people are comparing two products, let's compare JEPI, the most popular covered call ETF out there as far as AUM, and your particular product, SPYI. Similar makeup, but from a tax efficiency process, if you're in a taxable account, you're definitely going to come out ahead if everything else is the same because of that tax advantage.
It's something that we focus on a lot here at NEOS, not only from the actual research and construction of the products, what we put in the products like the index options, but it's something we focus on a lot of, because in the end, not only do we want these products that could produce a high distribution and appreciate hopefully with the underlying equities and move higher with the market overall, but we want to make sure that net after tax distribution is as close to the gross distribution as possible.
When you look around now, who's your typical investor? And we talked about this in a previous interview, but are you starting to see activity now that you're hitting that $1.3 billion of assets under management with SPYI and you see QQQI growing quickly? Are you seeing it from money managers as well that are starting to buy these products and incorporate them into their portfolios?
Sure. So if you think about our investor base, I'd say right now probably half of it is self-directed retail. That could be anybody with an online account. It doesn't kind of break it down towards what kind of income brackets or anything, but it's just someone self-directing, managing their own money. And right. The other half is more call it institutional money managers, wealth managers, and so forth, managing money for groups of people or for different funds. So it's kind of that 50-50 split. So we do have a good portion of the end shareholders of our products are individuals that want to get more income or looking to have a little bit more tax efficiency in their portfolio or lower volatility. So we're happy to always talk with people. We try to do whether it's interviews like this or webinars, but anybody can go on our website and reach out and ask a question if they needed to, if they didn't understand something, and we could have somebody get back to them.
for a individual investor out there that's trying to build out a portfolio, and I often say, be long the S&P 500, add some of this in there. Maybe you go 50-50, you're still going to get a 6.5% yield. That's pretty darn good. But you're able to hedge your portfolio a little bit with a product like SPYI or one of these other ones. And I also say it's best to take the best of breed, right? So if you've got a Russell, a NASDAQ, and an SP 500, you're just going to be able to mix these together a little bit. If your ultimate goal is having a pretty steady yield and something that doesn't give up your basis of what you put in there initially, then combining the best of these products together is probably a good way to go. Is that kind of what you hear too, or is that your line of thinking?
Yeah, we've heard from a number of different advisors that look at these products and think about how they want to allocate these to certain clients of theirs. And some of them look at it, yes, they have this core S&P 500 exposure, but their clients, as they get older, might be looking for more income, and they still want to have that equity risk, but get that income. And that's where maybe a product like SPYI might fit in. And it's not looking to replace that entire allocation, but yes, do you have it where you have some SPYI mixed in with an S&P 500 pure equity ETF? And yes, that brings down your overall portfolio volatility, but it raises your your distributions that you're receiving. So yes, you could have that blend where you're kind of half and half, like you were saying, and get a smaller distribution, but still have that overall equity exposure. And maybe that changes over time as the needs of that individual client needs more income, for example. We also talk to a lot of advisors that use these products and they just reinvest the dividends. And as their clients might get older, they might start to take some of the distributions. So since there's a nice, upside capture of the S&P 500, for example, or what QQQI has been doing versus the NASDAQ 100, sometimes they reinvest the dividends if they don't need them at the time, but can always turn them on at another time.
You have any thoughts on some of the products out there that are yielding like 50, 60%?
I would just say for anybody looking at anything in this space to just do your homework. It's very easy nowadays with how transparent ETFs are. You can go on our website, kind of dive into what our holdings are, what the products are doing. You could look at the holdings change on a nightly basis. At the end of the month when we roll those options, you can look that night and see what options are now in the portfolio. So I'd say when you're thinking about these products that might have these, very large yields, look at the product and can that product sustain that kind of yield and support it. For what we're doing here at NEOS, we're building products that are can support the distribution yield and continue to grow with the market as the market grows in those specific segments. Yeah, I think we've talked about this before, Dave, but look, some of these products have had to do reverse splits because they've eroded so much of the NAV. So is that yield sustainable for that specific product? Probably not. So not exactly what we're trying to do here.
I know you said Russell is coming out. Well, you're working on a Russell product.
Mm-hmm.
And you can't talk too much about that till they come out or you get to a certain point.
Yep.
You have others that are in the works too. Is there anything else that you can allude to?
So the other one we have in registration is a Bitcoin covered call. And we've had it in registration for a while, but we kind of switched it once the Bitcoin ETPs, they're not really ETFs, but the ETPs that are out now, whether it's IBIT or BITB or any of those, once they were released, we could kind of go back to it and really dive into how we're going to manage it. So that's in registration as well. We're waiting for this process. It's supposed to be about 75 days, and during that 75 days, the SEC comes back with comments, questions. We answer them. They might come back, but since this has been obviously a bigger focus for the SEC, in Bitcoin in general, there was definitely more comments, and it took longer than that 75-day period. So, but we're happy to get it out when we're able to. So hopefully this summer we'll have both that product and the Russell 2000 out. So we're looking forward to seeing what we could get out there soon.
So it's great to catch up with Troy and have him share his knowledge of his products. He's been around the industry for a long time and he's passionate about what he does. And the more we know, the better. So I hope you enjoyed it. And if you did, please like and subscribe, and we will see you next time. Have a great night. Take care. Whoop.